A bank charter isn't a marketing badge. It's a switch that changes what you're allowed to do with money. And on day one, the biggest change isn't a new product. It's that Ripple can stop operating around the perimeter of regulated finance and start operating inside it. Assume the approval is done, not pending, not in process. The regulated perimeter is now open, and Ripple is legally allowed to operate with bank-grade permissions. Here's the contrast that matters. Most people think finance is about moving money. Institutions know it's about controlling the conditions under which money can be held, deployed, and settled without breaking the risk model. That's why the same transaction looks simple on the surface and complicated underneath. The complexity is the system doing risk work. So when a company crosses into bank-grade status, what changes is not the story you tell. It's the range of actions that become legal, supervised, and scalable. You don't just gain credibility, you gain an entirely different operating menu. And that's the question this video answers. What changes the moment Ripple can legally hold, deploy, and intermediate money like a regulated bank? And why does that shift Ripple's role in settlement infrastructure in a way most crypto companies will never be allowed to replicate? Everything here is for educational and entertainment purposes only, not financial advice. Always do your own research before making any investment decisions. If clear, no hype crypto education helps you make sense of all this. Hit like and subscribe. It tells YouTube this series is worth showing to other newcomers, and it helps me keep building it for you. Most crypto infrastructure still lives outside the perimeter, even when it's compliant. It can serve institutions and integrate with institutions. But it still has to route around the most restricted part of the map: the legal ability to intermediate regulated money flows as a supervised institution. That boundary line determines who can custody regulated funds, who can hold client balances, and who can deploy liquidity without stitching together legal workarounds. It separates infrastructure that can sit inside the plumbing from systems that can only connect at the edges. Bank-grade permissions don't just open doors. They also close shortcuts. You inherit supervision, capital discipline, reporting, and auditability. The kind of operational gravity that makes institutions treat you as infrastructure, not a vendor. And paradoxically, those constraints are part of the advantage. In institutional finance, being constrained the right way is what makes your outputs usable. Here's the first concrete shift on day one. Money stops being something Ripple merely routes and becomes something Ripple can legally hold and intermediate under bank-grade rules. Outside the perimeter, many firms function like connectors. They move instructions and facilitate settlement. But the regulated money itself lives on other institutions' balance sheets. That's where the legal weight sits. Inside the perimeter, Ripple can hold regulated forms of money with clearer authority over how those balances are managed and safeguarded. That changes institutional behavior, because institutions care less about your interface and more about your legal posture. This is the moment most people miss. Most crypto companies will never be allowed to hold and intermediate money this way. Not because they're bad actors, but because this permission set is rare by design. So the day one impact isn't hype. It's that Ripple can operate as a supervised balance sheet actor, not just a technology layer pointing at banks. Now zoom into the part most people never see: Treasury. Treasury decides where money sits, what it backs, and what risks it can absorb. Day one is when Treasury can move from reliance on external partners to something Ripple can operate in-house, inside a bank-grade framework. That matters because institutional settlement isn't just moving value. It's managing exposure windows. It's ensuring liquidity is available the moment obligations crystallize. It's preventing operational friction from turning into credit risk. A bank-grade posture changes how Ripple can position liquidity, manage buffers, and govern internal flows. It also sharpens the role of a regulated stable dollar. In an institutional context, it's not just a token. It can function as a treasury instrument under explicit rules. The next change is subtle, but decisive. Once you operate with bank-grade permissions, deploying money becomes a regulated decision shaped by risk. Outside the perimeter, liquidity is often treated like inventory. Inside the perimeter, it becomes balance sheet capacity. It has constraints, costs, and risk weights. That discipline enables structured deployment institutions recognize. It allows intermediation that fits governance models instead of bypassing them. In institutional finance, risk isn't something you discuss after you ship. It's what determines what you're allowed to ship at all. There's a difference between liquidity access and liquidity control. Access means reaching liquidity through partners, exchanges, and integrations. Control means managing liquidity under a supervised operating model, where it sits, how it's deployed, and under what rules. Most crypto firms live in the access layer. The control layer belongs to banks. With bank-grade permissions, Ripple can move closer to that layer and participate in regulated workflows institutions already trust. That's why routing matters. Modern routing isn't about finding the cheapest path. It's about selecting a path that satisfies legal, liquidity, and risk constraints at the same time. Now we can talk about XRP, but in the correct lane, not as a price story, as a role story. Outside the perimeter, XRP can sit awkwardly in some institutional flows because every step has to be mapped for risk and compliance. Inside the perimeter, the frame changes. XRP becomes one instrument among several that can be routed depending on constraint. Sometimes the right tool is a regulated stable dollar. Sometimes it's tokenized deposits. Sometimes it's corridor liquidity. And sometimes a neutral digital asset still plays a role when systems don't share a native settlement layer. The key point is not that XRP becomes mandatory. It's that Ripple's permission set changes, which conversations XRP can be part of and how those conversations are underwritten. Institutions don't react to headlines. They react to allowable workflows. They ask whether something can be custodied, settled, audited, supervised, and explained to boards and regulators. A bank-grade Ripple doesn't guarantee adoption, but it changes due diligence and expands what partnerships are plausible. This is the difference between crypto integration and financial infrastructure. Integration is experimentation. Infrastructure fits institutional governance by default. The contrast remains. People think finance moves money. Institutions design systems to manage risk and make settlement legally final. A bank charter changes who is allowed to do that. It moves a company from the edge of the map into the part of the system where balance sheets and supervision define reality. If Ripple is operating inside that perimeter, day one isn't an announcement. It's a new rulebook, a structural shift most crypto companies will never be allowed to make. Thanks for watching, and I'll see you in the next deep dive. This channel is for educational and entertainment purposes only, and is not financial advice. Always do your own research and keep the discussion respectful. If you enjoyed the video, please consider liking, subscribing, leaving a comment, or sharing it with a friend.